The Eurozone's common currency has been steadily losing value as worries about a recession there rise in response to growing uncertainty about the bloc's energy supply, with Russia threatening to further cut off gas supplies to Germany and the rest of the continent. The likelihood of a downturn in the economy also raises the question of whether the European Central Bank will be able to tighten monetary policy enough to control record-high inflation, as indicated by France's EDF announcing additional electricity cuts. Deutsche Bank noted in a note that the stress points go beyond the German natural gas crisis to the larger European energy market. The video is going to be very interesting, so make sure you stick till the end. Before we continue to our video, make sure to smash the like button, subscribe to our channel, and hit the bell icon to never miss any of our future uploads. Now let's get started. Trading Economics, an online data company, predicts the euro would decline to 0.975 by April 2023, echoing this opinion in a more upbeat manner. The price of a euro is predicted by Wallet Investor, an algorithm-based price prediction service, to fluctuate between 1.23 and 1.36 before reaching 1.31 in 6 months. The Eurozone inflation rate is currently running at a record high 8.6%, and the ECB has stated its plan to raise interest rates for the first time since 2011. These developments have dimmed the prognosis for the European economy. The challenge for central banks around the world is to control inflation without worsening existing economic slowdowns, which the data suggest are becoming closer by the day. The Fed has already begun to tighten, having increased its benchmark rate by 75 basis points in June while drastically downgrading its growth projection for 2022. The most recent Federal Open Market Committee meetings minutes revealed that officials are concerned that if inflation worsens, the central bank may lose credibility. Capital economics markets economist Francisco Palmas claimed in a research report on Tuesday that investors across asset classes were underestimating a relatively unfavorable economic result in the Eurozone. We still anticipate them to struggle, she added, although we think it would require a significant further deterioration in the outlook for the Eurozone economy for the underperformance of the euro and Eurozone assets to continue. For one thing, we anticipate continued shortages and high petrol costs throughout the Eurozone. This is one of the reasons why, despite merely anticipating a slowdown rather than a cessation of Russian gas supplies, we expect the Eurozone economy to border on recession this year. Additionally, Lucio Sarno, a professor of finance at the University of Cambridge, notes that the U.S. interest rates have been growing for a while now, in contrast to Europe, which makes investments in the U.S. dollar region more alluring. Pros and cons of dollar being stronger than euro. When the dollar appreciates against other currencies in the foreign exchange market, it is said to be strong. A stronger U.S. dollar makes it possible to purchase more foreign currencies than before. For instance, a strong dollar helps Americans who travel abroad but disadvantages international visitors to the United States. Let's examine the benefits of a higher dollar. Number 1. Traveling abroad is cheaper. American citizens with U.S. dollars have more purchasing power abroad since those dollars can travel farther. A strong dollar can buy more items when converted to the local currency because changes in U.S. economic conditions have little impact on local prices in other countries. Number 2. Imports are cheaper. If the value of the currency used by the manufacturer declines relative to the dollar, goods produced abroad and imported into the U.S. will be less expensive. The monetary value of high-end European vehicles like Audi, Mercedes, BMW, Porsche, and Ferrari would all decrease. A luxury car from Europe that cost €70,000 will cost $94,500 at the current exchange rate of $1.35 to the euro. If the exchange rate falls to $1.12 for each euro, the identical car that was previously selling for the same amount of euros would now cost $78,000. Import costs will continue to decrease as long as the dollar remains strong. Number 3. Multinationals that do business in the U.S. benefit. Investors and foreign businesses with significant U.S. business will profit. Gains in the value of the dollar will translate to gains on the balance sheets of multinational firms with significant U.S. sales and profits. These companies' investors ought to receive compensation as well. If we discuss the cons of stronger dollar then. Number 1. U.S. companies conducting business abroad are hurt. Companies with headquarters in the United States that do a significant amount of business abroad will suffer as the value of the revenue they generate from international sales will fall on their balance sheets. Investors in these businesses are likewise probably to suffer. Philip Morris International Inc., PM, and McDonald's Corp. MCD are well-known examples of U.S. businesses having a sizable portion of their sales coming from abroad. Although some of these businesses employ derivatives to protect themselves against currency risk, others may only do so partially. Number 2. Tourism to the U.S. is more expensive. With a higher dollar, foreign visitors will discover that American goods and services are more expensive. Business travelers and foreigners who live in the U.S. but maintain bank accounts in their home currencies or receive paychecks in those currencies will suffer, and their cost of living will rise. Number 3. Exporters suffer. Domestically manufactured items are comparatively more expensive abroad, just as imports are less expensive at home. If the dollar strengthened to 1.12 to the euro, the price of a car built in America that cost $30,000 would be almost $22,000 in Europe. However, when the currency strengthens to 1.12 to the euro, the price rises to almost $26,000. Some have suggested that pricey exports may result in the loss of American jobs. Effective strong dollar on US and Europe citizens. The growth of the dollar above all other currencies has had a dual impact. Much like the job market, where historically low unemployment has led to both a labor scarcity for businesses and an abundance of opportunities for employees. Recent global shocks, such as the conflict in Ukraine, have boosted the value of the dollar because during turbulent times, investors, businesses, and other nations frequently store their reserves in dollars. But the struggle against inflation is the main driver of the strong dollar. The Federal Reserve is raising interest rates in an effort to combat the present, almost continual rise in prices, and it announced last week that it anticipates further increases this year. The currency will rise as rates are raised further. Why the dollar smile leads to frowns. Contrary to popular belief, when the U.S. economy is weak and the rest of the world is experiencing a recession, the value of the U.S. dollar tends to decline. Investors see the country's currency as a chance to lock in growth in either scenario, or as a reasonably secure location to deposit capital while they weather the storm. Due to its inclination to climb at both extremes, the phenomenon is frequently referred to as the dollar smile. However, the rest of the globe has less reason to smile. A rising dollar might harm nations with smaller economies for 3 major reasons, according to Manik Narain, head of cross-asset strategy for emerging markets at UBS. Additionally, it could result in increased financial burden. Not every nation can borrow money in its own currency because its institutions might not be trusted by foreign investors or because their financial systems are less established. As a result, some are forced to issue debt with a dollar value. However, if the value of the dollar surges, it will become more expensive for them to pay back their debts, depleting the government's coffers. Additionally, importing fuel, food, and medication becomes, for nations who might otherwise be able to benefit from a depreciated currency, to export more of their own commodities, which have become more affordable. The odd confluence of circumstances is making matters much worse. According to Mr. Prasad, a weak currency might occasionally act as a buffering mechanism, causing countries to import less and export more. Many people are not feeling the benefits of stronger growth today, though. They still have to pay more for imports of necessities like wheat, oil, and medicines, in addition to loan payments on multi-billion-dollar loans. A year ago, $100 in oil or a $100 debt payment would have cost 1,572 Egyptian pounds, 117,655 Korean won, or 41,244 Nigerian naira. Assume there was no inflation or price growth. Implications of a strong dollar. Because imported items are less expensive when the currency is strong, domestic inflation is kept under control. As prices grow, a dollar may purchase more products and services. A 14% increase in the dollar can have a discernible effect on inflation because the United States is a significant net importer. According to research by the Federal Reserve Bank of Cleveland, a 1% increase in the dollar typically reduces non-petroleum import prices by a total of 0.3% over the course of 6 months. A fraction of that decrease reduces inflation as a whole. It is hardly surprising that the Treasury and the Fed have not expressed much opposition to the recent dramatic increase in the value of the dollar. For investors, keeping a globally diversified bond portfolio is difficult due to the rising dollar and high U.S. interest rates. In contrast to the U.S. yield of 3.42%, the Bloomberg Global Aggregate ex-US Index's yield to worst is only 1.84% with a duration of 7.6. Hope you guys enjoyed our video. Make sure to subscribe to our channel and hit the bell icon for more videos. Thanks for watching. and have a wonderful day.